Good afternoon, everyone. It's a pleasure to be here on another Umbrella Saturday. This is a special one for us because we have a special speaker, someone I hold very dearly, and I belong to a community where he also belongs to, with Oyeka community, where I've seen the wealth of knowledge that he displays. Mikail Adekunle is someone that I hold very dearly, especially when he starts to speak about venture, startup, investments, and the likes. Today's topics, as you all know, we like to start at exact time, is from risk to return, rebuilding trust in Africa's venture investing. My name is Ayola Viomi once again, and we have Mikail Adekunle, VC at Black Entrepreneurs Fund, BDC Capital. Hi, Mika. How you doing?
I'm good, Ayola. Thanks. How are you doing?
I'm doing great. I'm doing great. Good to have you here. Usually, we start with just a bit of your background so that we can have some context to who you are, what you've done, how you've done it, what has changed for you, how you transitioned from Nigeria to Canada, still working in the VC space. And then we just jump right into the session. If you have a slide, then you might want to share your slide, but if not, you can just speak to us on the topic. I have a couple of questions for you, so I'm sure the way we also take questions would be that the audience will raise their hands up if they have questions for you along the line while you speak. And then if you have the time to give us clarity for it, that works. If not, if you want the questions to come after you're done speaking, that also works. So what model would you like to go with?
I'm comfortable with anyone actually. So I think it depends on what the group thinks. If they are comfortable asking questions as I go through the slides, so that maybe they don't forget what their train of thought, then that's fine with me. And I can also wait till the end. Anyone is fine with me.
All right, so we will take along the line so that we don't forget the questions, and then it's also we get more clarity along the line.
Okay.
All right. So I think you have the right to share. Yeah, so you can share.
Okay, let me see. Just a moment. Please let me know when you can see my slide.
Yes, it's up. Thank you. It's up.
Okay. Right. And let me just get to it should disappear very soon. All right. Thank you everyone for being on the call, and Ayola, thanks for this opportunity. I can see some people that I know already on the call. Gashola, Adaku, and Co. So that kind of talks a little bit about my background, where I'm coming from, and all that not so amazing stuff. Okay. Yeah, I think I started with the table of content, but we'll come back to that. So a little bit about my background. So this is my background in a nutshell. On the left-hand side, you can see my work experience and the industries I've worked in. And I've basically worked globally, almost on every continent, except South America. I started off in Nigeria, then moved all over the place, Middle East, Asia, Australia. Now, right after my university in Kuwait, it's because I studied in Kuwait. I did engineering in physics with a minor in economics. And part of the reason for that was because I always knew I wanted to be an engineer, but at the same time, I knew that whatever you build, you need to be able to sell it. You need to be able to make money from it. So that's why I combined economics and engineering physics. So on the right-hand side of the screen here is my education. I went to Air Force Military School in Jos. Really proud of that because it's the only Air Force military school in the whole of Nigeria. So did that, then moved to Kuwait for my BSc. Like I said, after Kuwait, I then moved to the UK for my master's in engineering. And then after my master's in engineering, I got a second master's in technology management from Canada. And right now, I'm currently working on my third master's degree, which is a global MBA. And it's a global executive MBA that sees me traveling to different parts of the world every 2 months. Been to Germany for classes, the US, I'll be going to India next, then China, Japan, and different parts of the world. Unfortunately, I did bring it up with the school that, hey, why is Africa not on the electives? Because believe it or not, it's a global MBA in global locations where we take classes, but there is no Africa. There's no African country on any of the electives, which is kind of sad because one of the classes I'll be doing in the US, they're talking about the global market, and there's a big section on Africa. I'm like, well, I've just gone to Africa to go and talk about Africa, right? Because what we do is when we go to China, you get a professor from China that tells us everything about China, doing business in China, and all of that. We'll be going to Japan, the same thing, technological advancement in Japan, their history, where they're going to. Again, it's a Japanese professor in a Japanese university that is doing all of that. But then when it comes to Africa, then, they're like, yeah, we tell you about Africa in the US or we tell you about Africa in the UK. Hopefully they fixed that. I brought it up and I think they're currently looking into it. But yeah, so that's the summary of my background. In terms of the industries I've worked in, I've worked everywhere from retail all the way to oil and gas, manufacturing. Then I co-founded two startups. One failed, woefully, after 2 years. The second one is still ongoing right now, but I'm no longer involved with it. And right now, I'm currently working with BDC Capital, and I will touch more on BDC Capital later on because I think it's a key part of the presentation I'll be giving today. So I'll touch on it in a while. But BDC Capital essentially is the VC company of the government. So the government owns it. Government is our single LP, our limited partner. So every funding we get to invest, we get it directly from the government. So what that means is the money we're investing at BDC Capital in Canada is basically taxpayers' money. So that's it about the intro. I don't know, any questions? Or Ayola, do you want us to just jump into the presentations?
Well, I think we can jump into it. I think we've already covered a lot.
All right, sounds good then. All right, so let's go to the table of content. So for today, we'll really be talking about is there really funding problem, on the continent? Because we all think that there's a funding problem, but then again, is it true? And if it's true, we'll take a look at why is that the case, and then how do we rebuild trust in order to either fix what's happening if there's a funding problem, or if there's no funding problem, then we can also keep rebuilding the trust so people know that there's no funding problem. It's just a matter of growth that we need. And then one key part of the conversation we'll be having also today is about discussing if we need the government and the role of the government. Now, I know a lot of entrepreneurs, or a lot of us in Africa generally, we've been burnt by, the government, so to say, that we always say, look, we want to do everything without the government, we can do it without the government. So we'll also touch on that as well. And then last but not the least, we'll take a look at, are there any hopes for the future? Is it even what, going along this journey as well in terms of rebuilding the ecosystem and also increasing the funding opportunities? So let's start with a more of a global venture landscape. Now, I took the year 2022 because the year 2022 has been agreed that I think globally that was the record year for African venture capital investment. And in that year, in Africa, I believe we did roughly $5.4 billion, give or take. Just 5.4. Some people say it's 5.8, some say it's 6, but it's roughly 5 plus. That's what we did in Africa. Now, globally in the whole world, there was over 445 billion venture capital investment that happened in that year. But Africa only got 1% of that. Now, in order to contextualize challenges for minority founders or minority, ecosystems, I put all these figures there. For Black entrepreneurs globally, what the data shows is that they were only able to raise 2% of global venture capital. Now, for the African continent, just 1%. Now, when you look at Black women got roughly 1%, but it's actually less than 1%. We just rounded it up to 1%. Now, for women-founded startups globally, again, they only got 2%. Now, these numbers are good for us to understand so that we really know that it's not just an African problem. It's really more like a minority problem, but part of the reasons also includes those people in the venture capital space who are writing the checks. Globally, majority of those who write the biggest checks in the world are usually, white old men. So, of course, there is all this conversation around how they think about risk, how they think about founders they're interfacing with, and who they back as as their investment. Now, again, still looking at, is there really a problem? Absolutely, yes, there's a problem, as we've seen on the previous slide. But then again, in terms of Africa right now, let's focus on Africa. As of this year, the US alone, they've already had 793 unicorns. And just to carry everybody along, because I want to believe everybody knows what a unicorn is, but just to touch on that, a unicorn is basically $1 billion company in terms of valuation. And I know Dr. Shola doesn't like valuation, he likes revenue. I like revenue too, but for the purpose of venture capital, we all talk about unicorns because, again, that is how we kind of judge success in the venture capital industry. Now, the other thing also to talk about here is on the continent of Africa, we also need to be very, very clear and agree on how we define success for our startups. Because the way we define success will determine how far we go. Now, currently in Africa, I believe about 70% of the venture capital investment across the continent is from outside the continent. So majority of it is from North America and Europe. And the problem with that is that whoever brings in the most money to your ecosystem, they control the narrative of how you define success. So unfortunately, on the continent, we are having to define success for startups as, unicorns. Now, there are different conversations, there is the whole camel startups, there is giraffe startups. Those are different conversations entirely. But then again, we need to be able to talk to ourselves and decide on, do we want to stick to the unicorn, standard? If we want to stick to the unicorn standard, then we need to basically, follow the path, as well. Do almost everything the same way they're doing it in the US, or outside Canada, outside Africa. But just to give us a context, Africa to date has had 9 unicorns. And these are the companies on the right-hand side here. You've got InterSwitch, Flutterwave, OPay, Wave, all the way to MoneyPoint and Time. 9 of them in total from the continent. While, like I said, in the US, they've had over 793. And in fact, Sweden, that has the least number of unicorns on this chart, actually has 8. So Sweden alone as a country, that is not even, I don't even think Sweden, I don't even think their population is as big as that of Lagos. But they already have 8 unicorns compared to the whole of the African continent. That is something to kind of, give a little bit of thought into, is it because of the way unicorns are classified, or is it because of the ecosystem? Could it be because of our exchange rate? So, in America, for example, you can charge, say, let's use Netflix, for example. In Canada, I believe you can charge, Netflix charges almost $19 per month or so, but in Nigeria, it is less than that. So will that also be part of the reasons why our own startups are not necessarily generating as much revenue as their counterparts in the Western world. So those are some of the conversations to kind of take a look at. But then again, just to be clear, there is a funding challenge on the continent. Now, why do we have this funding challenge? One of the main reasons is basically because of, like we said earlier, the people that are writing the checks. They are mostly from outside Africa. And the problem with that is that they typically look at Africa from the outside lens. Not a lot of them have actually been on the continent or lived on the continent or experienced the continent to be able to understand what's actually happening in there. And even though they've been there, the challenges that we have in Africa has made people to start looking at us in different lenses. Now, one of those challenges is that idea of, oh, Africa is too risky for venture capital investment. That is a very, very big issue that we have on the continent with the way people see us from outside. And part of the reasons they think that, oh, Africa is too risky for investment because of some of the macro risks. And macro risks will be the overarching issues that we have on the continent in the various countries that we have. So currency fluctuations, for example, regulatory instability. For example, in Nigeria, I believe since the new administration came in, the currency has lost a huge chunk of its value. So if you were a foreign investor that put in, let's say, your US dollars or whatever in a Nigerian startup, for example, you will have lost a whole lot of that value. And now when it comes to you taking that money out of the country, then again, you don't really even know what will be the currency situations when you're about to take it out. So that is one of the fundamental issues that we have on the continent. Then again, the aspect of us having 54 different countries on the continent, while it's a blessing in one sense, it's also a cost in another sense. And part of the reason is simply because as a founder or as a company or as an entrepreneur, and if you're building in a country, it will be completely different from you moving to a different country and building in that country. Yes, it's still the same Africa, but like I said, Africa is 54 countries, almost different languages, different tribes, different regulations, and all that. So it does bring that added level of difficulty for when a founder wants to scale. Now, that is not to say it's not possible. Founders are not doing it. Yes, they are doing it, but the perception is that it is more difficult for you to do that on a continent with 54 countries rather than doing that, let's say, in the US, where you've only got, 54 different states or thereabout, and you can just move from one state to the other. So again, if you're building in Lagos, you can easily scale the company to Port Harcourt, to Abuja, and different parts of the country. Same thing with South Africa as well, from Johannesburg, Cape Town, and all that. Now, the next issue again, which is, I think I should have put this on top of the list because this is arguably, I think, the most challenging part for African venture capital, and that is scarce exits. I think we've only had roughly, no, I think there's a slide on that. We'll get to that, but we don't have that exit record to be able to back why we want investors to come invest in Africa. And the thing we need to understand is that VCs typically don't usually own that money they're investing. It's not for them, it's for their LPs, which are the limited partners. And these LPs want their money back. So the VCs will typically look for ecosystems that will help them grow the money and be able to return the money to their LPs. Because one thing we need to understand is that even VCs themselves, at the end of the day, they are kind of money managers. They have a job and they need to do their job well to be able to keep their careers as well. If they go put money somewhere where they are not able to take out the money and give it back to their LPs, then that becomes a problem for them. Because for you to raise a second fund or the next fund as a VC, you need to be able to return money to your LPs. And then LPs will be like, oh, wow, okay, Ayola, you've done great with the 1 million I gave you, you gave me 5 million back. You know what? I will give you 3 million for your next fund or 5 million for your next fund because now I trust you. So that scarce exit that we are facing on the continent that stems from limited track record for IPOs and acquisitions on the continent is one of the fundamental issues that we're having on the continent. Now, the last but not the least, which unfortunately most people like to talk about, is the issue of fraud. Now, this is what most people put out on social media. We talk about it a lot when there's a case of potential fraud in the ecosystem. Everyone writes about it, even those who don't have the info. They don't have the details. Everyone wants to post on LinkedIn about it. Now, yes, it is true that this kind of paints the continent in a bad light. Yeah, and one other thing that I hear people talking about when it comes to this notable fraud, especially African founders or Africans in defense of not necessarily defending the fraud cases, but saying things like, oh, by the way, after all, it happens in the US as well. So why is everyone talking only about the African situation? Now, the problem with that is that, yes, it does happen everywhere. Fraud happens everywhere in the world. But the problem is that in Africa, it gets magnified because of the limited funding that comes into the continent. So if, let's say, we get $5 billion investment in a year, and then one founder, makes up with $500 million or just $1 billion, that is a huge chunk of that money that was invested in the ecosystem. Now, contrast that with, let's say, the US, for example, where maybe they raise, I don't know, let's just say, for the sake of argument, $300 billion. Even if a couple of founders were to defraud their investors of, let's say, anywhere from $1 to $5 billion, the ecosystem might not really feel it that much. And then the other thing also is that because the US has been able to produce a whole bunch of unicorns and successful startups, then whatever fraud or downside that happens during the investment history or investment cycle in the US, it then gets chunked down to, oh, these are some of the outliers, not necessarily, oh, this is exactly what the US ecosystem is, just a bunch of fraud people. So that is something that we need to understand. Yes, the fraud cases in Africa are significantly lesser compared to the US. However, due to the amount of venture capital funding that comes to Africa, it gets magnified. And then plus, again, we have a whole bunch of us that like to type on LinkedIn, and then we start drying our dirty linen in public. So there is that other aspect of it as well. So again, the impact of all of this is that trust deficit that we're talking about. Investors don't necessarily trust the continent, and they don't trust some of our founders due to what they've had, either first-hand experience or, second-hand experience from some other people. And yeah, if anyone has a question, Ayola, maybe you can track that and just let me know so that we can answer all the questions while we're going on.
All right. Yeah. Well, no problem.
Okay. So now zooming into the exit challenge that we just talked about, in the sense of, VCs typically wanting to get their money back so that they can give it to their LPs. There are different layers to these challenges that I'm talking about. So one of it is on the development of most of our stock markets. In Nigeria, I think they've done a little bit of work to be able to clean it up during Obasanjo's time, which is about, I don't know, 4 administrations ago. South African stock exchange is also doing okay. I know the Egyptian one is doing well as well, but I don't know of all the 54 countries. But however, our local stock exchanges are not well developed, so to say. And apart from that, some of them are actually not big enough or robust enough to be able to admit a whole bunch of startups that want to get listed. So that in itself is a big problem, because in the venture capital world, investors typically back a company to be able to get all the way to IPO. So really, IPO is like the holy grail of venture capital, not necessarily acquisition. Acquisition is good too, but IPO is the holy grail. So we don't have a lot of that on the continent. And that's a very, very big challenge for us attracting funding into the ecosystem. Now, the next point is about limited pool of buyers. We don't necessarily have a secondary market or even other companies, other businesses, other big players acquiring startups. So you see, for example, you see a big bank, I don't know, IBTC or Standard Chartered. They might need, let's say, I think I even saw this with some of the companies in Nigeria recently, where a whole bunch of them are creating their own apps, either for investment or to be able to attract, young professionals. Now, while that in itself is okay, all right. However, the problem with that is that it would have been great if, let's say, a GT Bank goes out to acquire a fintech, or IBTC or Standard Chartered goes out to acquire, a startup and then use their product to scale. That will definitely help boost the liquidity issues that we're having in the ecosystem. So if we keep seeing a lot of acquisitions going on the continent, then more investors will actually see that as an opportunity for them to bring their capital in, because now they know, hey, there's a lot of buying and selling going on in the tech ecosystem. Either my startup gets to IPO or someone acquires them along the line, but I will definitely get my money back. But we don't have a lot of that on the continent. Now, the other part also is the microeconomic challenges. I touched on it earlier on, where we are having currency fluctuations, and then either currency fluctuations or instability, political instability here and there on different part of the continent. That also kind of scares investors away. Then we also touched on the regional fragmentation, where we have 54 countries on the continent. Now, with startups, investors typically want you to scale. Now, if you're focused on the continent and you're having to scale to 54 different countries, investors are already looking at how difficult that will be, language barrier and what have you. So typically, they will look at that as a downside for an African startup. While, like I gave the example of a US startup that can scale all over the US and then Canada, boom, it's gotten the whole of North America already. We don't necessarily have that easy understanding of how fragmented the ecosystem is. Now, again, touching on the exit challenges that we're having again, this data was actually gotten from what was put together by a Stanford University professor that looked at VC-backed companies in the US over a period of time. Now, what he found was that in the US, stock market, VC-backed companies actually accounted for 41% of the market capitalization. Now, that is really, really huge, because that's almost half of the companies, half of the money in the stock market in the US coming from VC-backed companies. So you are talking about companies like Google, Amazon, Uber, Twitter, Facebook, and the likes. They own a chunk of that stock market. And in the same vein, VC-backed companies are responsible for a really, really large part of R&D research going on in the US, up to 62% actually in the US. Now, in Nigeria, for example, again, I use Nigeria as example a lot because I'm originally from there. So typically, I will be inclined to kind of use that place as example. Now, when it comes to Nigeria, interestingly, we have zero venture capital backed companies on the stock market. Now, this in itself is really, 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 how do I put this nicely, affecting us. So I have been investing in the Nigerian stock market for a really long time. I think as early as maybe I think 2000, maybe 2001, I started investing there. So I've kind of followed the track record of the market as well. I would have loved to be able to invest in any of the startups that we currently have, but our startups are not getting listed on the stock market. Flutterwave, for example, I'm hoping, I'm praying that it breaks that cycle, because there's already conversation in the media that I read where they want to get listed, I believe, I think it's going to be a triple or double listing where they list on the stock market, on London Stock Exchange, I think in New York and in Nigeria as well. If they do that, then they will really be breaking the ice for the country and for the continent. Now, like I said earlier, VCs typically want a company to get all the way to IPO. Now we've got MoneyPoint, Andela is a unicorn as well, but none of these guys ever got listed on the stock market. Now, they all have their reasons, and I don't necessarily fault them. But then again, having more startups get listed on the stock market will definitely help how the ecosystem is being perceived. Now, for the global IPO, just taking a snapshot of just this year, just to kind of contextualize what I've been talking about, the IPO and the stock market. In the US, in just the first half of this year, over 100 companies, over 100 startups, or let's say companies, over 100 companies got listed on the stock market, while and that resulted in about 14 billion US dollars. While again, on the African continent, I couldn't get the actual number in terms of number of companies that got listed, but then the data shows only 2 companies got listed. I want to believe there's a little bit more than that, but overall, it's still 0.1 billion US dollars in terms of the capitalization they added to the stock market. Again, this does not really look attractive to VCs that are looking to back a particular ecosystem. So again, I am trying to kind of paint the picture of why there is skepticism or why VCs are not necessarily invested in the ecosystem. A lot of people like to think it's mainly because of founders or founders fraud, this and that. No, that is not the main issue, to be honest. It's typically because of lack of, well, all of these things we've talked about, lack of exit, the fragmentation, and what they feel as the macro challenges of the ecosystem. So now, how do we rebuild some of this trust? I didn't want to even use the word rebuild. I wanted to just say, how do we build trust? Because kind of debate, well, you can actually debate the fact that we've lost some of the trust we had, or we never did. We're just building the trust and we need to get to a higher level of trust. But so in terms of VCs, what are investors doing to be able to be confident and sure enough that they can invest on the continent? So investors, by investors, I mean people like myself, either investors on the outside or my senior colleagues that are working in Africa. What are they doing to be able to help mitigate some of these issues? Now, one of it is the stricter due diligence. So now you hear a lot of founders say investors are asking for a whole lot of things. In fact, for me now, if I'm going to invest in a startup, I even want to talk to their customers. And what I started doing also is even sitting on some of their sales presentations. So I can just introduce myself to the customer and be like, hey, I'm only here as an observer. We're hoping to invest in this company. Is it okay if I sit down on this, on this call? Some say yes, some say no. When they say yes, that's great. And I'll just mute. I might not even have my camera on. And part of what I'm trying to watch out for is this founder really great at selling? So I have a really huge sales background. And for whatever you're building, like I said earlier, whatever you're building, you must be able to sell it. And apart from that, I want to be able to see how customers see the product and all of that. And again, there are a couple of other things that we see in that when we sit on those sales calls, but that's a different thing entirely. But yes, so VCs are now doing much more deeper due diligence as far as, even checking your bank accounts. Some of them even now have either a dedicated IT team or they get they contract out some aspect of their due diligence to different IT firms. And what the IT firms will basically be doing is they can go into your data room or even go into your numbers just to make sure that what you're providing is actually accurate. Because again, we've seen instances where founders are inflating the number of users or, just to be able to please the VCs. So now VCs actually, taking a more hands-on approach to fact-checking some of those things. Then the other thing also that we started doing as well is having local partners. And this local partners is very, very key, especially when the VC is not very present on the continent. Now, the local partners typically we have different benefits that they can add to the conversation. One of them will be actually doing the due diligence. Some of them actually go out into the field with the founders to see how the founders are selling their products, to actually see what the market is, what the market feedback is with regards to what the product the founder is selling. So local partnership is becoming a big thing. Then the other thing also is in terms of portfolio governance, VCs are no longer wanting to have a hands-off approach anymore. So if no matter how small your check is, you will want to still have some insight into what the startup is doing. Now, if you're an angel investor and you don't necessarily have the big check or the clout to be able to impact or to be able to see exactly what the founder is doing, in that case, what you try to do is make sure that you co-invest with a VC that has the capability to be able to help you do some of the things that you want to do. So a VC that sits on the board, monitors the founders' spending and how the startup is doing. Now, last but not the least, the days of fake it until until you make it is hopefully getting far behind us. And what I mean by that is VCs are no longer just looking at social media posts, looking at what you're posting or what people are saying about you only. They are doing more in-depth due diligence, like I said. So it's no longer, because we've seen situations where founders get like I don't know, a startup newsletter or startup company, startup media or someone to talk about them, paint a very good picture of them. VCs are becoming wary of all of that. They will dig deeper just to find out that the company is actually doing exactly what they are saying they're doing. Now, for founders, we talked about how VCs are kind of helping to breach that, rebuild the trust in the ecosystem. Now, for founders, really, some of the things that founders can do is understand that in this venture capital space, trust is a very, very big commodity. Now, trust doesn't just come from, word of mouth. It comes from your behavior, your activities, how you carry yourself, how you interact with the ecosystem, how you interact with VCs, other founders, and even your customers as well. So transparency and integrity is really key now. Try to be upfront with your investors. If you have a problem, tell them what the problem is. Don't inflate numbers. Be as dignified as possible in everything you do. A VC you're trying to impress might not actually be the best VC for you. Don't try to force it by doing all sorts of shady things. And the truth of the matter is that if you stick to what you're doing and you're doing it properly, with time, you will start to see the benefit and other people will start to see the benefits also. Now, the next thing also is for startups to try and strengthen their governance early enough. And part of the reason for that is that as a VC, when we see startups that already have, a good enough governance in place, we are usually pleased with that because it kind of gives you that satisfaction and that confidence that, I think this founder knows exactly what they are doing. This founder will be kind of trustworthy, so to say. And that's simply because they've already started thinking about being diligent on either their finances, their startup, their journey. And that kind of gives us the confidence that if we back such a founder, we are hopefully going to be backing the right kind of person that is not in it to defraud us, so to say. Because again, I have had a lot of founders who say, "Hey, after all, the VCs are rich, so what does it mean for them to lose a little change? Why are VCs complaining?" So now the next thing also is to try and build relationships and not just make it transactional when you're talking to VCs. Because I've seen a couple of founders who will typically come to a VC when they need money, and the way they usually approach it is more like, "I need the money now," kind of a thing. And again, as a VC, you might be saying, "Hey, I don't know you from Adam. Why should I give you money?" So it's always good to build that relationship so you don't start raising capital exactly when you need it. You try to raise, you try to start building the relationship well before you need to start fundraising. Now, last but not the least, leveraging mentors and networks. And I think there's a slide I'm going to kind of buttress this point there, but absolutely, as founders, try to work with accelerators. The good thing working with accelerators is that it serves like a badge of honor. And I'm glad that a lot of founders already know this. So that's why you see founders having things like YC backed or Techstar 2024 or something like that on their LinkedIn profile or even in their company name. It helps to show the world that look, YC is backing us, Techstar is backing us, so we might be doing something right, and it will be good for you to back us. And then also other founders or maybe exited if you have access to other founders, senior founders, exited founders, or founders that have done what you're trying to do, it's always good to try and leverage that relationship as well, because they might be in the best position to introduce you to a VC that ends up backing you. So again, like I wrote in red there, credibility is your biggest asset as a founder, but again, not just as a founder, but the whole of the African continent. We need to build our credibility, and for foreign VCs or VCs abroad, I mean investors abroad, but even for ourselves at home and for other Africans in the diaspora. And the reason I'm putting this point there is that I have tried raising capital from some high net worth individuals who are from the African continent, but based either in the US or Canada. And it's usually a shame when they tell you things like, oh, no, they are still skeptical about the continent. They've been burnt, either they sent money home, their family members did not do something with it that they're supposed to do. Even the financial institutions, some of the people here will tell you, oh, they don't trust, the banks in Nigeria, that look at how they've been in the news. One bank manager stole money and then, jackpot with it or ran away with it and all that. So even our people that are abroad, we need to be able to show that credibility, not just to ourselves on the continent, but to our people abroad and also to investors as well. So for founders, this is something that typically we don't talk a lot about. We say relationship, build relationship is key and all that. But I put it in here as also one of the other things that founders can do to help get funding to the continent. Now, I talked about building relationship with trust. You don't just try to raise capital when you need the funding. Now, this is a study that was done by Harvard Business School a couple of years ago. And they basically looked at how VCs source their deals. The largest part really comes from networks for VCs, trusted networks. Now, it starts from a VC's former colleague. For example, just this week, one of a friend, I would say, he works with a fellow VC or accelerator rather that also invests in VC. It's a global company, it's a global accelerator. And all he did was just send me a WhatsApp message that, hey, they're taking a look at a particular company. Do I mind also taking a look at them so that we can co-invest? And that was all. He just sent me their details. And right now we're taking a look at that company. Now, as a founder, you will not be able to do that directly or straight away. So VCs will typically lean on other VCs to get deals and to also co-invest. However, VCs also do outreach to startups, to founders, and that's also another 31% of how VCs actually invest in startups. The way they do that is either maybe, we saw you at a pitching competition, or maybe you posted about your product, or we saw a review, or in the age of AI right now, which is something that's very big that we're doing, there are different tools out there that we use in sourcing deals. So again, VCs use any of those means to find which companies to reach out to. The next one is referrals from other investors, which is the example like I gave also earlier on, which is someone reaching out to me and then telling me, they're doing a deal. But then last but not the least, or well, second to the last, is the referral from portfolio founders. Now, I talked about leveraging your network in the previous slide, where either with founders or accelerators, it is very key to also interact with founders, and that's why what with Onyenka community does is quite impressive. Although it's a platform where we come together and discuss different things, there is an opportunity for it to be bigger, for it to be more in person, and for it to be more personal. And that is what the community is actually building as well. I believe there's an event coming up in Lagos pretty soon. But again, it will give all the founders opportunity to meet one another, to build that relationship. And so if one founder happens to get investment from an investor, he or she can always refer another founder from the community, or is a friend of his that he knows that is trying to raise capital. So referrals from portfolio founders also is something that VCs also look out for. Now, last but not the least, which is unfortunately where a lot of African founders find themselves, that's cold emailing to investors. Yes, it's a hit or miss, and like the data shows, only 10% of the investment that VCs do comes from cold email. Yes, cold email does work. Yes, jumping into a VC's DM, it works as well, but it doesn't work as well as building relationships or getting referrals from other people. So it will always be good as you're building your company and you think you'll be needing funding maybe in the future or whenever, just start building the relationship from now. And the thing is, when you're building the relationship from now, it doesn't always have to culminate in money, really. It could just be a building the relationship for future purposes. For me, for example, when I was building relationship with some VCs back in the day, I was building the relationship towards hopefully raising capital. But unfortunately, now I've moved into the VC world. And because of that, I'm able to either co-invest with them, either even refer some of the startups that I know to them, and all those kind of things. So you never know when that relationship is going to pay off. So just start building relationship as you build your company as well. Now, this is where it gets really interesting for me, because a lot of what on the continent hate the government. Well, not just the continent, but all over the world. I'm not sure a lot of people like their government, but when it comes to venture capital, there is a case to be made for government to get involved, and I've got a couple of slides to back that up after this. Ayola, how are we doing for time?
We're doing great. We're doing great. Questions will come in. We're doing great.
Okay, all right, good. So, case for government. This is something that I think on the continent, I don't know how to put it nicely, but we really, really need to be on the neck of our politicians if we truly want the ecosystem to grow. Startups are doing their best. They are building great products, solving great problems, resilient founders, but the government has a really, really fundamental role to play. And for me, it's something I know the conversation is going on as well with VCs and politicians right now, but I think this is something that even founders also need to understand. Now, how does government intervention help? It really helps to address some of the key market gaps that we'll talk about within the ecosystem. Now, the first part is that, like I said earlier, foreign investors think there's a lot of risk in investing on the continent. Unfortunately, we don't have a lot of our government involved in startup investing on the continent. Now, if I'm a foreign investor and I want to invest in your country, for example, or on the African continent, and even your government is not backing you, then really, why should I put my money in that country or that continent to back such founders? Yes, I might see a couple of successes coming here and there from the continent, but then again, if the government is not putting their money where their mouth is, if let's say the pension funds, for example, are not investing. So to give you an idea, in Canada here, one of the biggest investors in startup are actually the pension funds. But we don't have any of that on the continent. We don't have much of that or any of that on the continent. And it's something that if we improve that, it will definitely help. Now, a lot of the VCs in Africa, usually write smaller checks or raise smaller funds. Government coming into the play will actually help boost some of these VC funds and even help boost the ecosystem as well, because government could potentially generate larger funds for the ecosystem. Now, in terms of the long-term sustainability, by having the government get involved in this, then VCs or people from outside will know that, look, this is a long play for them as well as the government, because now the government is looking to boost their own economy. And typically when government do things, they're usually doing it for, for sustainable purposes, hopefully for long-term gains. So governments getting involved will actually boost the confidence and the morale of VCs that want to look into the continent. Now, to back this up, let's take a look at some of the countries in the world that have actually gotten their government to back the startups or to back the startup ecosystem. Now, we'll be looking at a couple of countries here, so there's Canada, Denmark, Finland, France, and all of that. Now, I work for BDC Capital, and I said I was going to touch on this again. So, governments typically do this through what we call developmental banks. Now, I work for a company called BDC Capital. BDC Capital is a subsidiary of BDC, which is the government's developmental bank. And in Nigeria, I think we have the development bank. We have a development bank in Nigeria as well, but they don't do venture capital. They mostly do capital projects and all of that. Now, to give you an idea, my VC firm that I work for, as of 2024, we actually had roughly $7 billion asset under management. That is the money that we have to make investment in the ecosystem. Now, the highest money that we looked at that the whole of Africa generated was 2022, and it was roughly 5.4 billion. So just to give you a context, my firm alone is actually sitting on more money than the whole of the entire African continent raised in terms of VC funding for 2022. And about 70% of what the African continent raised was actually from outside the continent. Now, what we do in my own company with this money is to invest in local ecosystem, the startup within Africa, within Canada. Now, Denmark has the same kind of company as well. They invest in Danish companies, and their asset under management about 4.5 billion. Again, this is just for Denmark. This is just one government entity having this amount of money to invest. Then the list goes on and on. I believe France has the highest, if I'm not mistaken. Yeah, France has the highest, where by France, yeah, they've got roughly 17 billion asset under management. So again, this is just to buttress some of the point I made earlier on to say that government actually needs to get involved, because by government getting involved, they can catalyze the ecosystem. Imagine half of the countries on the continent getting their government to earmark some amount of money into the startup ecosystem. All of a sudden, there will be more activity on the continent. More investors will have the confidence to actually come into the ecosystem, bring their money now, because they know there is a larger pool, and hopefully there will be more liquidity going around on the continent. Now, to look at some of the breakdown of, again, a lot of this data I got from a recent OECD venture capital report that came out. So anyone that wants to look into the data as well, to just maybe read up on it, you can always look it up online. Is OECD venture capital, I believe venture capital report 2024 is 2025. So now this is just to take a look at who are the people that are investing in some of the leading venture capital ecosystem. And by the way, just to point out here, UK, France, Germany are among the top 10 countries for venture capital investment globally. Canada is one of them as well, but Canada was not added to this particular frame for just this particular was an exercise in looking at who are the people backing the ecosystem. So now taking a look at who are the people backing the ecosystem in some of these countries, the public sector, which is the government, accounts for a large chunk in places like Finland, France, Germany, And then the pension funds, like I mentioned earlier on, in Canada, pension funds are one of the huge investors in the venture capital ecosystem. In Africa, we don't have that. The problem again with that is that if you don't have some of these big players bringing capital to the table, then there will be that liquidity issue. And again, for us, where we're having only 30% of the money in venture capital space coming from the continent itself, that is not really a great signal for other people to bring in their own money to come and back us. So this is just to kind of buttress the fact that public sector money, pension funds, and even businesses in Africa, in Nigeria that I know of well enough, not a lot of businesses understand what startup or venture capital investing is. So a lot of them don't do that. They don't get involved. While in other parts of the world, you could see a manufacturing company investing in, startups that are building something for industrial technology or so. You could see, a lot of CVCs, that's corporate venture capital, out there, but we don't necessarily have a lot of those. And again, to my earlier point of not having secondary market or having a good buying and selling activity within the venture capital ecosystem, it would have been great if some of the banks in Africa already have their own corporate venture CVC, corporate venture capital divisions where, say, imagine like a GT Bank or a Standard Chartered Bank having, let's say, $100 million dedicated to just investing in fintechs. Now, what they can do is invest in a whole bunch of fintechs on the continent, and any of the fintech that does really well, they can just acquire that fintech, and then, that is them expanding their footprint. That is them moving into the digital world. If we can do more of that, then there'll be more liquidity and then there'll be more confidence for people to bring more money into the ecosystem.
Okay, so Mikail, let me ask you a question. Let me just
Yep.
ask you a question. Could this also be an infrastructure problem? The infrastructure that would allow some of these things to exist doesn't really play out the way it plays out in, some of these developed countries.
Well, that's a good question. Yes, there is the infrastructure part. However, if we actually want to do this, we can build infrastructure for ourselves. Now, let's take a look at what's the name? Let's take a look at the stock market, for example. What some of the VCs say is that some of the startups that want to get listed are not necessarily robust enough, or they don't have enough money, or they don't meet the capitalization requirement to get listed on the stock market. Now, one way for us to kind of mitigate that could be, okay, either maybe the stock market lowers the entry barrier for startups, or we could have a secondary stock market where startups can go in there at a lower valuation, get listed, get people to back them with funding, and then as they grow, they can then graduate to the main stock market where they need a higher valuation or higher market capitalization to be able to get into. In Canada here, we have that. We have a lot of penny stocks here in Canada that are actually listed on some of those, on this second tier stock market where you can see stocks that are as low as, I don't know, is it 0.2 cents or is it 5 cents or something like that? We can always build that infrastructure. And again, it's not necessary. Yeah, so when I think about the infrastructure we need to build, I don't see it as a challenge because the fintechs have kind of showed us that they could build the infrastructure for payment if allowed to do so. So if we really need infrastructures for allowing either pension funds or say startups to get listed on maybe a second tier stock market, I bet you we can get a fintech to actually build that. We can build that. So the infrastructure is not necessarily the problem. It's more of the desire and the drive to do it. So in places like Canada, I like using Canada for example because, well, I live here right now, but hopefully that will change if you guys decide to bring me back to Nigeria. So now, using Canada as example, for some of the pension funds, they already know how to invest in startups. So what they do is they don't put the bulk of their money in startup because, hey, as a pensioner, I don't want you gambling with my money. I'm giving startups that are likely to fail. No. So what they do is they take a little chunk of their money to invest in startups. But even with that little chunk, there's a way that the government actually supports that. So it's not necessarily guaranteeing the money they put in, but there's a way the government gives them incentives so that even if they were to lose the money or part of that money, there's a way the government compensates them for taking that risk. So again, that is a mechanism that is very, very easy for our policymakers and our financial gurus to work out how to support the ecosystem by working around some of those things.
Okay.
And again, I would
To
yeah,
jump in
go ahead.
here, I was at US Nigeria trade something for startup, right? It was a startup conversation, right? And they had the
Yeah.
embassy and the rest of it there. And I think the guy from the PenCom, the Pension Commission, came around, and spoke around. They're trying to do this thing in Nigeria. They're working with a few VCs. They're trying their
Yeah.
hands to understand that space, but it's retirees funds, right? They can't just take that funds and give it to a startup and
Mhm.
risk. And
Yeah.
I see how this plays out in foreign places where we say a lot of these funds are pension funds, they're insurance funds. How do we get the insurance company, the pension companies to also look this way, into the startup ecosystem? They claim to do a lot of structured deals rather than, they feel like the startup ecosystem is not so structured for them to put their money in it. And how do they
Yep.
explain to the people who own the money if anything goes wrong?
Oh no, that's true. And that's what I kind of so when you say how do we encourage those people to invest in the ecosystem, are you talking about foreign pension funds or African pension
African
funds?
pension fund. I'm looking inward
Okay, good,
because
good.
again, part of your speech is that a lot of these funds come from outside.
Outside, yep. Okay.
Maybe across Africa, maybe if those guys, if the insurance company, the pension companies can start to even allocate certain risk fund, let me put it that way,
Okay. So that's a good question. And again, like I said earlier on, even I will not want you as my pension manager to put my pension inside startup. No, God forbid. So typically there's a different model for how pension managers here in Canada invest in startups. So like the Pencom guy that was talking, I don't know. I wish I was there to kind of understand what they've done so far. But what they can easily do is learn from other parts of the world that have done this and how they are doing it. Look at places like Canada, for example. How is Canada was then able to encourage pension managers or pension funds to invest in startups? Look at how the US is doing it and every other part of the world. And then by the time you do your research well enough to see, so for example, there's some parts of the world where the government actually guarantees the money that pension funds are putting in the startup world. So the pension fund already knows that, well, if I was to put $2 billion into venture capital investment, even if that investment was to fail, the government will give me back the money. But here's the thing, they will also make sure to give the right fund managers that money to grow the money. So most of the time, the money ends up growing because here's the thing, as the pension manager is bringing that 2 billion, that is 2 billion liquidity going into the startup world. Other VCs will see that as a good signal and then bring in more money. And in venture capital world, money invites money. So the more people have it, the problem becomes when just one pension fund puts their money in there and all other pension funds are afraid to put their own money. Then all of a sudden, the money in the ecosystem is not really, it's not enough to
Fair enough.
invest and grow those startups. So there has to be a conversation around doing the research into different part of the world. How is it done in North America? If they are doing it in developing markets like Asia or India, look at how they are also doing it as well. And then also the government has to come into the conversation. How do we encourage people? How do you encourage pension funds to do that? There's a slide I actually have in there to show you guys how we are encouraging pension fund in Canada. Well, yeah, how my VC firm is actually encouraging was in Canadian pension funds to get into the space. But we'll take a look at that. So yes, it
So,
is doable and
Mikael,
we should
before
be doing it.
before you go further, right? In
Yeah.
Africa, We have a lot of unstable government policies.
Yeah.
So I
Yep.
know if you say the government should get involved, another government gets into power 4 years down the line or 8 years down the line. There's a disruption. He wants to start something new. He also wants to implement a new policy, a new process, a new whatever, you know. I think that that's where the problem is. It's not that we don't have the policy. It's not like I think with this administration, I think there's a three MTT whatever plan, program in stake, and there's
Yep.
that's box conversation that happened earlier, much earlier, and the rest of it, right? Um, Another person gets into power. He's another party. He's another, you know, different person. He wants to also drop
Yep.
something new. That's the problem we have. How do
Totally understand that.
how do they do it outside there that the policies stay regardless of the governments? Governments.
So how do they do it outside here that the policy stays regardless of the government? That one is a different ball game entirely. We will have to restructure how we run our political parties and all of that. In fact, how we run the entire country to get to how they do it here. But let's leave that aside. Now let's just focus on the continent right now. Let's just say Nigeria, for example, as it is. Sometimes our perception is kind of shaped or molded more on fear rather than actual reality. Now, I get your point. A government might come in now and say they are building a particular road. They start building the road and then they will stop and they want to use that road for campaign the next 4 years. And then they will stop. And then the next 4 years, they will now start maybe and complete it. Sometimes they will not. The next administration comes in, they don't touch that road. They go start something, another new road, and use that to keep insulting the other party. Now, we've kind of mentally and internally cascaded this example I gave to almost everything in the country or on the continent. Now, the reason I say so is because, yes, you are right. Some government will come in and change things and all of that, but it doesn't necessarily happen all the time. And then the example I'll give actually is perfect for the conversation we're having right now. Now, when a few years back, when I was in Nigeria working with one of the engineering companies, some of my friends and colleagues were talking about investing and all that. And we're talking about federal government bonds. And someone said the same thing you said, that, oh, why will I invest in federal government bonds when an administration comes in, they will just change the policy and they won't give me my money. But the truth is, it has never happened. When the federal government issues a bond,
that's what it is.
That is what it is. Even if, no matter if you like you're APC or PDP, when you come in, you have to stick and abide by that, by the bond details. And the same thing happened also back in 2015 or was it 2014 when we had the first Sukuk bond. In fact, that time I had a lot of people coming to me telling me, oh, why should they believe the government is going to pay back the Sukuk bond? Why should they believe this, believe that, and all that? And I was like, look, the only way the government will not pay back that Sukuk bond is if Nigeria gets invaded or the country gets destroyed, and then maybe we get invaded by a new foreign entity, and then they take over the whole country. That is the only way the government doesn't pay back that Sukuk bond. It's the same thing as the bond as well. So really, if we take that same approach and we put some of those same mechanisms into how we want to encourage pension funds and other funds or entities to get involved, then we will be fine. There will be no government again. No, let's assume Peter Obi becomes president. A full disclaimer: I'm not saying I support Peter Obi, I support Tinubu. I'm just giving an example of you Nigerian people before you come for me. So let's just say Peter Obi gets into power, the next administration. He will not just come and say, oh, okay, all federal government bonds, we are no longer honoring it. We'll keep the money. We'll not give you. No, nobody's going to say it doesn't happen. So while I understand the fear of other governments not continue other projects or keeping to their promises, when it comes to the financial sector or government commitment, like in terms of bonds and all of that, that is typically being held, well, will be no issue with that. So again, if we can use that same mechanism for the pension funds to get them to encourage them to come invest in the ecosystem, then I think we will be fine.
Okay.
Right. So good questions, by the way. Now, again, I wanted to take a look at how some of these countries have been investing, because again, I will kind of touch on the next slide. Will then touch on how this affects Africa. Now, a lot of the founders that I've met in Africa or that I usually chat with, they are usually at the early stage, either pre-seed, seed, early stage of their their startup journey. So what this chart is showing here is we're basically looking at how is the venture capital investment distributed across stages in a couple of countries. Now, as you can see, this bottom sign here in dark blue is mostly seed and pre-seed. Then when you get into the next one, the lighter color, then you're talking about startup and other early stages. However, in terms of the later stage investments, you can say that a lot of the investments in some of these countries are actually in the later stage of the VC of the startup journey. Now, the reason I brought this up is just so that we understand that even globally, most of the investments go to companies that are in the later stage, or late stage, later stage, or not really, really early stage, but they are already showing signs of growth to later stage companies. Now, the reason this is important is because at that later stage, the company is already showing traction. You already have customers. You already have good revenue. Like, even a blind person will see that, no, this company is doing something well. Now, the example I'll give is with MoneyPoint. I believe MoneyPoint raised about, I think, over $100 million recently or so from global investors. They were able to do that because really global investors could not deny the success and the traction that MoneyPoint already has. So one of the challenges that we're facing in Africa is that we don't have a lot of companies at that growth stage. If we had a lot of companies at that growth stage, in this area, in this bracket now, then we would then have a lot of VCs from outside that are already wanting to come in and invest in those companies because, like I said, there's already traction, everything is doing well. So Move, MoneyPoint, most of those unicorns that we talked about earlier on, or we're still going to talk about later on, they've already shown that traction. They've gotten hopefully, again, increase that our 30% venture capital funding that we currently have, increase it a little bit, and then focus it on this seed start attracting more venture capital investment into the ecosystem. Now, this is for these foreign countries, these global countries, right? Now, when you look at Africa itself, and I got this from the Big Deal guys. Anyone who doesn't know them, they're doing really good in terms of data and all that. That's a shameless plug for them. However, let's just take a look at last year's venture capital investment in the ecosystem. Only 10 companies in Africa raised over 50% of the entire ecosystem funding. And most of these guys raised 100 million and above. Again, it kind of speaks to what we said in the previous slide, where we said VCs, even in the developed world or, in other parts of the world, typically will put a lot of money into the growth stage. And of course, yes, it's also because growth stage will typically require much more capital. Yes, but this is just to kind of buttress the fact that the more companies we try as possible to get into that growth stage and later stage startup roles, then the more capital we can also attract from the diaspora or from abroad or from foreign investors. And this is just to kind of paint that picture of why we also need to do a lot of things at the grassroots to be able to get to this level. Now, diving into my own firm as an example of why government should actually back the venture capital ecosystem. Now, like I said earlier, my company has roughly $7 billion asset under management that we deploy into venture capital, into the VC ecosystem. But we do this in a couple of ways. One way is to do direct investment. And by direct investment, I mean we actually invest just like a VC does. We look for a company, we like the company, we carry out our due diligence and everything, and then we write a check for them. The other thing we also do is what we call indirect investment, which is funds of funds. We look out for emerging fund managers or fund managers that are raising capital, and then we give them money. So again, this is basically government giving other VCs money to go invest. And then when the fund does well, the government and the VC will share the proceeds. Now, just to give you an idea of how active we are the most active VC in the whole of Canada. And then as an LP, the capital that we invested in other fund managers actually represents 62% of all venture capital activities. So that is also to paint a picture of how important it is for government to actually play in the ecosystem. And if I'm not mistaken, Canada is actually ranked either, I know it's between sixth and ninth globally in terms of venture capital investment. And again, the government is actually a big part of that. Now, the other thing we also do is what we call targeted funds, where we create dedicated funds for any part of the economy or ecosystem that we think needs help. So, for example, we have a $500 million fund that only invests in women entrepreneurs. Then we also have a $500 million fund also that invests in just climate tech funds. Now, in the case of, let's say, Nigeria or let's say South Africa, for example, imagine if the government was to say, hey, you know what? We also want to start doing deep tech. We want to encourage fintech or something like that. So because of that, we plan to invest, let's say, $50 million in 2 funds or however funds that are specifically for fintech. All of a sudden, you will see more VC firms going into South Africa, trying to put more money, because if they put more money, they can get more money from the government as well. So this is just one way, and then an example of how the Canadian government is doing some of these things. And then there's another aspect again to it that I think we'll get to later on, but that's where the government earlier this year, because of the tariff issues with the US, the government was trying to boost the ecosystem and the venture capital initiatives and get more pension funds to kind of participate. And what the government did was to give BDC $1 billion. They gave us $1 billion to co-invest with pension funds and other institutional investors. So what that means is, as a pension fund, with the $1 billion that we have, we can say, hey, you know what? If you're a pension fund, for every 200 million that you bring, BDC will match that with 100 million or maybe 50 million, or we'll match it dollar for dollars. So all of a sudden, it's almost like the government is already guaranteeing the return for the pension funds. Because now, if the pension fund invests in a startup, then we'll be obligated to also invest in that same startup. So automatically, the company you invested in is already increasing in valuation immediately, just because the government puts money in it. So again, this is another way that the government kind of backs or supports some of these ecosystem players like the pension fund to be able to. And I think I shared that in the Witoyeka community also, where I talked about the $1 billion that we were given to invest with pension funds. Oh, okay. So yeah, I forgot I had a slide for that actually. So now, this is also part of what Canada does. Another example again. What I talked about is what we do as the VC company for the government. But what the government does is that government also has different kind of initiatives in the venture capital ecosystem, and then they give us that initiative to execute. So one of the initiatives that the government had was during COVID-19, when when a lot of businesses were suffering, either they were not getting funding or the activities were actually going down. The government actually gave BDC, again, that's my firm. The government created an initiative called Venture Capital Catalyst Initiative. There's VCAP, that's how we call them, in 2021. They gave us $450 million to invest in the ecosystem. Now, it was during that time that we invested in a new VC firm that happened to be the first Black-led VC firm in the whole of Canada in 2021. We actually gave them a seed check as an LP. So again, this was the government catalyzing venture capital within the Black community in Canada. So we invested in them as an LP. However, we also had this money that we invested as funds of funds, which is part of what I talked about, investing in the Black fund. Then we also had 50 million to invest in life sciences. And then the one I talked about that happened recently was the $1 billion to attract pension funds and other institutional investors. Again, this is another way that the government is using to catalyze and invest in different kind of venture capital initiatives within the ecosystem. Again, I'll keep hitting the nail on the head. We don't have these things on the continent in Africa. And it's simply because, well, there are a whole bunch of reasons and there are different schools of thought why the governments in Africa are not doing this, but we really need to get into the act of doing this. Now, I have a very, very promising example to give as to why government involvement is very key. Now, this is an example that I'm going to use from Israel. I want to believe that almost everybody in the venture capital world knows that Israel is one of the leading venture capital ecosystem in the world. When it comes to venture capital, invest, if I'm not mistaken, I think it's US, China, maybe Israel, or is it UK or something like that. People can always Google that to see it was a venture capital investment. So the example I was going to give is for Israel. Now, in early 1990s, let's say precisely 1993, Israel only had 2 or 3 venture capital firms only. And the government wanted to basically catalyze the innovation ecosystem within that, the innovation ecosystem then. And what they decided to do was to create a fund or, to create a government fund of $100 million and invest it in the ecosystem. But what they did was to be quite strategic as to how they deployed the capital. The initiative was to get a new Israeli venture capital firm to partner with a financial institution in Israel, and then also bring in a foreign VC into the equation. That's making 3 different entities. Now, again, this is almost like enticing people to come and invest in the ecosystem. Now, what then happened was that by just this initiative, Israel was able to attract 10 new funds into the country. And again, the new funds were mostly either, I think it was US, Japanese, and German VCs who went into Israel, partnered with local Israeli VC funds to be able to create those 10 funds. And what the government basically did was to give them roughly 40% of the fund they are raising, which is 20 million. If the requirement was for you to raise 20 million, the government gives you 40% of that, and then you invest it on behalf of the government. Now, by the end of that exercise, the government had generated over $260 million to be invested in the country. And by the end of the year, I think, 2000, the result was basically outstanding. By government investing just that 100 million, they've been able to attract investment into 164 startups. And for the 10 managers that were backed by the government, their asset under management ended up growing to $3.2 billion. And apart from that, the companies that were backed by these fund managers ended up accounting for more than half of the total VC funding in the ecosystem in Israel. So again, this is just to buttress some of the impact that government initiatives can have when it comes to ecosystem, catalyzing ecosystem funding and what have you. And, the other thing also to think about is that this $100 million was in 1993. So if you were to add, time value of money and all of that in today's money, you could be looking close to $1 billion, if not more than that the government put into the ecosystem back then. But again, we're not saying African governments should start putting $1 billion into startup, but it is something that can be done on the continent to basically catalyze local investments from local players as well as foreign investors as well.
All right. Thank you very much, Mikal. Go ahead.
Question?
Go ahead. Go ahead.
Okay.
There was a question in the chat box. I didn't want the question owner not to feel like we didn't want to answer it. So how do you initiate that long-term relationship with VC outside fundraise?
So good question. Of course, you just be yourself. You be yourself, post about your startup, this thing they talk about, building in public, start doing that. And of course, try to see how you can attend more industry events. Now, by attending industry events, what that helps you do is to be able to get in front of a VC. And of course, before attending industry event, it would be great if you do your research, find out, who are the VCs that will be attending, who are the ecosystem players that will be there. And when you get there, try to meet them, simple, being casual, introduce yourself, tell them about the problem you're trying to solve. And of course, a lot of them will be like, wow, okay, that's good. And the thing is that VCs, a lot of us like to think we're smart, even though not all of us are really that smart. But a lot of us like to think we're smart. We like to give advice every time. So almost every time you stand in front of a VC and you're like, you just wanted to, pick their brain. This is the problem you're solving. What do they think about it? This is your solution. What do they think about it? Every VC will typically want to give you 1 or 2 pointers. And by doing that, you can just say, can I get maybe your email or your card so that I can keep you updated about, the progress. And then you can even add them on LinkedIn if they don't have a card, or you can just add them on LinkedIn and then thank them for, if you're adding them on LinkedIn, you can remind them where you met. Oh, we met at this. Thank you for your insight. And then you add them up on there. And then you just gradually build the relationship from there. Going into DMs is okay. It's a hit or miss, but typically attending some of these local events. And oh, by the way, that does not mean you should stop building your company and then start attending all the events that you can attend, because trust me, I've seen some founders do that. Every event they are there. And then you start one, and then at that point, VCs will now be wondering, are you attending parties and events instead of building the company? So you just need to be strategic about how you go about it. So you build relationship by, being present, post about your company, talk about issues online, attend events, and also try to get warm intros if you can. If you see a VC you want to get introduced to, or a mentor, or or a founder, you can always either look at which connection do you have that can introduce you to them. And also the other thing also you can also do is not necessarily going directly to the VCs. You could go to their portfolio company founders. The good thing about founders is that founders love to help each other. So if you have a VC you're targeting, you can look at the list of their companies, connect with one of their founders, and then, pick that founder's brain, see how that founder can introduce you also to some of those VCs, tell them you're not raising yet, you just want to pick their brain, something like that. It's always good when we feel you're not being transactional, you're not just using us. You're not just using us for money. So when you start to build that relationship, you say, oh, I want to pick your brain. We feel like, hey, you're rubbing our egos more. So that will also help a little bit.
All right. Thanks, Mika. We have Kota. Kota, you have the mic.
Hello, good evening, Mr. Ayola and everybody. Good evening. Can you hear me?
Yes.
Yeah,
we can hear you.
All right. Okay. Thank you so much for this session. So when you were identifying the risk, you talked about the exit strategy for venture capitals and all that. So I want to ask you, what's the best strategy to woo a VC? Like, okay, maybe in the next 5 years, you're invested in my company and this is going to be the valuation or something like that. What do you think is the best way to actually really woo them, giving them sort of a guarantee for the exit strategy? The second thing is, when you were mentioning the things that could actually help the ecosystem for visitors. I remember Vusi Tembowayo of South Africa said something that if we have a situation whereby some venture capital take it upon themselves and say, okay, if this company is not doing too good, because I'm looking at as a startup, if the risk was, oh, maybe in the next 3 years, the company is not doing as planned, as projected and all that stuff, but the company actually have prospects. Another VC can say, okay, I'm going to be exiting in this 3 years. Can another VC buy up my investment from here and take it up, since you already believe in this company. Can that work? Sorry. Thank you.
Okay, thank you very much. So, well, the first question, what you asking, I smiled because you said, how, sorry, I'm smiling. But you said you used the word guarantee. How do you guarantee exit? Oh my God, guarantee is the last thing we ever about. It's a word we don't even use in venture capital and startup because there is no way you can guarantee. Well, really, should I say there's no way you can guarantee exit? Yes, I think I'll stick to that. No, there's no way you can guarantee exit in 5 years or 10 years. It might come sooner, it might come later, it might never come. So typically the word guarantee, I wouldn't use that. However, yes, there are ways that you can absolutely tell VCs that, look, if you invest in me, there is this potential. And I think I have that in one of the slides that we'll be talking about, I think, but I think you beat me to it, or maybe I forgot to mention that. But when African founders are pitching to investors, one of the key ways of hooking an investor is to actually tell them how they will make money from investing in you. And how they make that money is that exit strategy that you potentially have for them. Now, you don't necessarily have to put that in your pitch deck, but you could speak to it when you're pitching to investors or when you're talking to investors. And the good way to do that is always make sure you've done the necessary research in your own space to know how previous companies in your space have either exited or have scaled. So for example, if you're in fintech, you might want to look at, oh, I'm building fintech in maybe this particular space. How have other fintechs done, either globally or even in Nigeria, for example? So you might be able to actually have concrete examples to show them that, oh, if you invest in us in the next 5 years, there's a possibility for First Bank to actually acquire us. First Bank is looking at doing XYZ. There's a possibility of them acquiring us, or maybe there's a possibility of maybe Uber or whatever company acquiring us and using us as their payment platform for their startup. So there are a whole bunch of ways that you can actually not guarantee, but let the VC understand what are some of the exit scenarios or exit possibilities. Because believe it or not, whenever a VC is talking to a founder or looking at a startup or evaluating a startup, one of the main things that is on our mind is always, how do we make money from this? How do we exit from this startup? So if you as a founder can actually help us and actually get to that conversation even faster, then that will be great. So yes, but again, like I said, it is startup dependent. Look at what other startups have done. So for example, on the With Oyeka community that we are on, the founder, Oyeka, he co-founded Trips. And Trips is basically Uber for buses, or Uber for commercial entities, so to say, so for employees. So companies can actually get his own buses to actually take their employees from point A to point B. Now, if I was Oyeka and I was speaking to investors, I can always tell them things that, look, we're doing really great and we see an opportunity where maybe in the next 3-5 years, there's a possibility that Uber might actually acquire us, and then Uber will then integrate us into their platform and use us as their corporate mobility division or something like that. Now, as an investor, once I hear that, that kind of sounds interesting, I actually might like that. Now, will that happen? Is there a guarantee that will happen in 5 years? No, there's no guarantee to that. He might also say, hey, look, you know what? With what's happening in the airline industry or in the cruise ship industry or something, there's a possibility that maybe a big airliner might want to diversify their portfolio, or maybe, and they want to go into corporate mobility or something like that. There's also opportunity for that, for them to acquire. So yes, absolutely, you can definitely do that.
Sorry,
now,
let
for
me
the
come
next
in.
question,
Sorry, sir, before you further. So actually, I'm in the food space, the food and beverage space. So I would like to put it to you. Are we in the risk section of BC, like food and industry? Because more of the guys that are here are fintech, but I represent the food and beverage.
what did you say?
Food and beverage. Okay, so take for instance, we do about teas, we do chocolate peanut butters, we do palm oil and the like. So I'm in the food space. So I'm trying to wait this a VC, and I'm saying, okay, the exit strategy is that there's a lot of tractions. I'm getting this guarantee that with this particular set of companies, blah blah blah, and all that stuff. So that's what I'm saying. Can you speak to that effect at the food
Okay, so
company?
yeah, I can do that. So now let's say, so again, let's say assume you're in the food space and you talked about some of these, let's assume you do chocolate bars, smoothies, and all those things, right? So yes, you can absolutely talk to an investor, and some of the exit strategy that you could pitch for the investor could be, hey, look, we're doing really great, and then you can then look at maybe a couple of the industry players in Nigeria, for example. So again, you might say, hey, look, you know what? UAC actually does something similar in the food space, but we are doing really better than them. There is an opportunity, there could be an opportunity for UAC to actually, and UAC are the one, just for everyone who doesn't know, UAC is also in the food space. They own a couple of restaurants, Mr. Biggs. Most of them are closed right now, but then they own Gala and other eateries like that. So there is an opportunity for actually, in fact, your case is a perfect example because there's an opportunity for UAC to actually acquire your startup, grow it and expand it. And even apart from that, UAC, so UAC typically was a standalone company, but then they were acquired a couple of years ago by a private equity firm out of London. And so the private equity firm is called, I believe, Helios. Is it Helios Capital? It's owned by a Nigerian as well, based out of the UK. Now, I know this because I followed their history and their record while they were on the stock market. Now, these guys, the private equity firm I'm talking about, they invested in them, they grew them, and I believe they sold their equity. So even that private equity firm actually could be a potential acquirer of your company. Once your company grows big enough to let's say private equity standard, they could always come in and say, hey, look, you know what? We want to buy you, grow the company, and then get it listed on the stock market. Now, again, because of the space you are playing in, depending on how ambitious you are, another exit strategy could potentially be you growing big enough to actually list the company on the stock market. Now, to give another example, there's a company out of Ibadan called FTN Cocoa. As a couple of years ago, FTN Cocoa, their stock price was like, I think it was like 0.5 kobo or something like that. It was that small. I think right now it's now maybe 5 or 7 naira or something like that. So again, they only had one location, they grew it. I think they sell cocoa, other cocoa and cocoa byproducts or something like that. So you absolutely have a bunch of opportunities to scale or even to exit. And again, depending again on who gets interested in what you are building, you can end up having a situation whereby the likes of maybe Tantalizers or even maybe Mr. Biggs want to revive themselves and then they want to have small eateries or some other kind of food products that you already have. They could potentially acquire you as well. So again, there are opportunities for acquisition, and even you yourself as an entrepreneur, you could actually follow up with some of these potential acquirers. So you could reach out to, if you're at a networking event, you run into the CEO of UAC or FTN, like I said, you could even pitch your company, hey, what do they think about acquiring you? That is something that founders typically don't do, but you can also do that as well. I hope that helps a little bit.
Yes. Thank you. So this for
You're welcome.
the second thing I mentioned like what Vusi said about VCs taking the risk upon another VC so that maybe we can grow that ecosystem.
Yes, so it happens. And again, it kind of boils down to some of the things I said earlier, where I said a lot of the VCs that we have in the country are usually smaller VC in the continent, are usually VCs that have smaller check sizes. So if we have, let's say, we're able to have VCs that have larger check. So for example, here in Canada, I think there was a VC that raised almost $800 million recently. Now, such a VC can look at a company that maybe is either struggling with finances and say, look, you know what? We believe in this company. We think their product is good, but they need more money to get to where they want to get to. You know what? We'll buy out, we'll clean the cap, we call it cleaning the cap table. We'll clean the cap table, buy out all the other VCs, invest heavily in them and help them grow. Now, an example of how that could play out is imagine a startup that is in the industrial innovation space. Industrial innovation space is typically capital intensive because maybe you're building robots, you're building mechanical arms, it's basically industrial scale startup activities. They're usually capital intensive, and that's one of the reasons why our VC firm actually created a dedicated fund, about $400 million that government gave us just to dedicate to that space, because we know that it's capital intensive and we want to actually support VCs that have actually invested in that. Now, because we created that fund, more VCs actually started investing in industrial innovation space. And then they will come meet us and then we add more money there. And other VCs who have struggling startups will come to us and then we actually back those startups if we believe in them to actually grow. So yes, it is possible, but the problem again with that is the capital. We need that capital to be able to do that. Now, let's stick to the industrial innovation space. Imagine we're able to get, let's say, a Julius Berger or Dangote Cement or any of these industrial juggernauts to actually create a CVC, corporate venture capital entity. And then they start backing some of the industrial startups within the ecosystem. Then we could also do that as well. So let's say a VC that invested in a pre-seed stage company, the company is manufacturing something that makes the cement industry more efficient. By the time the company gets to, let's say, Series A or B, they need more funding. The earlier VCs don't have the financial muscles to back them. Then we could have, let's say, a Dangote corporate venture capital VC come invest in that startup and help them grow. So yes, it is something that is doable, but it's a secondary market play that we don't necessarily have, or we don't have a robust kind of activity in that space on the continent.
Thank you.
No, thanks for that. Yeah, continue.
So I think
okay.
Yeah.
All right. So yeah, we were talking about the doom and glooms, but now let's talk about is there any light at the end of the tunnel, or should we all just go to sleep? But no, that's really not the case. There is definitely light at the end of the tunnel. And then when we talk about case for optimism, we've all, we kind of talked about some of the unicorns that have come into play in the last few years. But apart from even those unicorns, we're having some sonicorns, so to say, that are soon to become unicorns. And even apart from that, we are beginning to see a gradual growth in a lot of the startups within the African ecosystem. And, I think there's a slide I'm going to touch on where it dated the startup ecosystem in Africa, and it dated it back to like 2010, because really 2010 was when we started documenting and seeing good enough activities within the venture capital ecosystem. So in the grand scheme of things, we are only 15 years old in the venture capital journey. So it's not the end of the world, but we are still at the early stage. So it's good to know that right now we're beginning to see potential for exits coming up, acquisition, IPO. What was the name of this company? Is it Paystack that bought this Stripe also for 200 million a couple of years ago? Something like that. And then so we are beginning to see glimpses of hope, and hopefully that will keep going on. And then the other thing also is that we all talk about the market fundamental for Africa. Africa is 1.4 billion people, young people, tech savvy. Although I don't like talking about our population all the time, because at the end of the day, not every one of those 1.4 billion people can afford the different kind of tech solutions we are building today. So really, the market is not the entire 1.4 billion. However, we do have a young, diverse, and digitally savvy people. I mean, young people who are, looking to try a new product either in the fintech space or thereabout. And this will just continue to grow. The next thing also is that we're beginning to have more sophisticated investors. So whether you like it, whether you believe it or not, it was actually a whole bunch of African VCs that invested in the likes of Andela, Flutterwave, and the rest, that actually got them to where that gave them the seed funding to be able to get to the stage where they got capital from foreign investors. So in that aspect, we are kind of getting sophisticated, but we haven't gotten to to our bus stop yet. But then there's the opportunity there, and a lot of the foreign investors are kind of doing what I like to call wait and see. So they are waiting to see what developments, what opportunities come up on the African stage. So they basically want to see, they see Africa as the next big frontier, right? And this ecosystem, and the ecosystem is promising enough for them as well. However, they are waiting for the right signals, and the signals could be, oh, okay, government involvement or more exits and all of that for them to come back to bring in more money. So there's that increasing sophistication of the ecosystem. And then last but not the least, the ecosystem is maturing. We are having more collaborations. Even I think the Money Point raise that they had at the end of last year, it was more of a collaboration between African VCs and foreign VCs that actually brought in the capital. And then we are seeing situation where companies like Antler, the accelerator program, they've now opened shop in Africa. I believe Textiles was there in Nigeria for a while, although they left. But again, it's just a good signal that the collaboration is going on. And even the companies that Techstars backed in Africa, a lot of them are still doing well. So that is actually good to see. And then now, again, continuing on the story of being optimistic, like I put it here, joy is coming. It's not about that song. It's just that I was looking for a header for this slide, and I thought this was a good one. So when we talk about optimism for the future, it is actually, like I said, it's actually very good to see where we're coming from, where we are at, and hopefully how we can grow from there. Now, let me start with the right-hand side with the chart. Like I said, the dating of the ecosystem kind of started in 2010. That was when Africa, the entire African continent, raised $35 million. So again, to put that into context, the entire continent raised $35 million, while in Israel alone, like we said earlier on, they had what? They had 10 VCs sitting on almost 3-point-something billion asset under management as of 2000. So 10 years later, we're only raising 35 million. But then the good thing is that as of today, or rather, let's stick with the glory days for Africa. As of 2021-22, we were actually able to raise $5 billion. So in roughly a decade, we went from 35 million to about 5 billion. Now, we can absolutely do better, but again, it is something to kind of be optimistic about. So hopefully there'll be more success coming on. And then the other thing also to note also is that within 2010 to 2017, there were almost 600 companies, 600 startups that got VC funding on the continent. And the whole of that funding was roughly 2.4 billion. However, 5 out of these almost 600 companies, only 5 of them actually returned roughly $2.5 billion. So that is a great sign. This is already a great signal to investors that, look, if only these 5 companies can actually generate $2.5 billion, imagine what happens if the rest of these companies, of course, most of them have died, but there are some of them are still existing. But then again, imagine what will continue to happen if we keep getting backing from investors and the likes. And then the other thing also is that these companies now, a lot of them, as they succeed, their founders will start backing the ecosystem as well. So I believe one of the founders, or is it the main co-founder of Paystack, I think he started his own VC fund, if I'm not mistaken, that is investing in startup. And again, the rest of the other co-founders as well, or the people who have cashed out, they will also invest back in the ecosystem. And the VCs that back them as well, actually doing well as well, because of the fund the fund they raised back then. And then the other thing also to notice that we also have unrealized capital in some of the unicorns that we saw earlier on. And what that just means is that although they are now unicorns, but they've not yet returned the investment money that was given to them by the VC. So you have the likes of Flutterwave, Andela, and the rest. Now, once maybe those folks get listed on the stock market or there's an acquisition situation, then all of a sudden, this 2.5 billion is potentially going to increase as well. And then we'll start to have more success on the continent. But at the end of the day, we need to be able to have more exits, more success to be able to attract venture capital funding.
All right, thanks, Mikail. And this is like a masterclass. I'll let
You have
you.
another question?
Yes, I have a question for you, right?
Go ahead.
I'll just do two questions because I know you've spent
Okay.
a lot of time with us and it's morning over there in Canada, so we don't take your entire morning.
No,
But we all agree that regulations often scares investors, right? How can African governments balance protecting consumers with creating an investor-ready environment?
protecting consumers and creating an investor ready.
All that, yeah.
No, so again, it's yeah, African government can do that. I think pretty. I don't want to say pretty easily because I I can kind of get where that question is coming from. So, for example, again, using Nigeria, I think it happened in Kenya also, where the government came up with different kind of policies in the fintech space
Yeah.
to protect, to protect consumers. But again, some fintechs think, that's too much, that's overreaching. At the end of the day, I think the government needs to collaborate with the ecosystem, with VCs as well as startups as well, rather than just having some old politicians in their offices or in CBN just enacting laws and claiming they are protecting consumers. There should be a conversation around how do we go about protecting consumers without necessarily affecting the startups that are building for them, as well as sending out the wrong signals. So all of this is it's about collaboration, collaboration, collaboration. The best way to do it would be to talk to to these startups, to the VCs, let the government let them understand why why they want to do what they are doing, and then the VCs or the startups can then tell them, hey, look, you know what, maybe we can change this, tweak this, and then everything becomes compatible with the law you're about to pass. So to give you an example, in Canada here, we have what we call accredited investors. So if you are not earning up to $200,000 a year, if your salary is not up to $200,000 a year, then you cannot invest in startups in Canada. And again, Canada is doing that to protect you that want to become an investor. They are saying, look, because startup is very, very risky. Startup business is very risky. If you go put your money there and you're earning less than 200,000, if you lose your money, then that's going to be a problem for you. So because of that, there's a regulation that you have to be a sophisticated investor to be able to invest as an angel investor or directly in startups. So that alone, one might think, that is going to affect, what do you call it?
Investment pool.
The number of, number of people that go into angel investment or startup investing. But the truth is, the government is doing that to protect those people, but also protect even the startups as well. Because once startups start to collect money from almost everybody, then that's when the startup fails, lawsuits will start flying up and down. There will be chaos in the ecosystem. So that is why the government is trying to protect those kind of people, and then also in the back channel support the ecosystem one way or the other. So yeah, so while regulations are needed to protect, the consumer, because at the end of the day, like Kauthar now, for example, at the end of the day, we don't want her to go and be using the wrong ingredients to manufacture her food products just because they are cheap. So no, government will definitely put regulation to say, hey, you cannot use this kind of chemical or that kind of chemical as preservative, because the government is protecting the populace. So it's now left for her to then look at what other safe product can I use, can I add to my food product to be able to meet that requirement. So I think at the end of the day, startups need to understand the space they are going into, understand the regulations in that space, and understand how to solve for that regulation rather than trying to go against the regulations. But again, the government also needs to be able to collaborate with the founders, with the startup ecosystem, with entrepreneurs to understand, what are the challenges? If we pass this regulation, for example, how will that affect you? Let's sit and talk. So again, for the fintech example I gave earlier, again, it would have been good for the government to basically sit with the likes of MoneyPoint, Flutterwave, and other ecosystem players to say, okay, this is what we're trying to do. How will this affect you? How do we work around that? All those kind of things. So I think it's doable. It's just a matter of collaborating, and then everybody understanding that the government is not out to kill. Well, the government making it known that they are not out to kill the startups, and the startups should also understand that the government has to also protect the people using their product as well.
Okay, So I think my second question is just based on your experience, how much does political risks really factor into VC's decision making in Africa or in the African?
Wow, that's a good question. So, to be honest with you, it does factor, and it factors a lot. So, to give you example, I don't think I know any VC in this world that is investing in Somalia or even in South Sudan, because they've got serious political issues there, right? So, funny enough, even in Nigeria, even as Nigeria is one of the leading venture capital ecosystem in Africa, I still get VCs saying, look, some VCs saying they don't want to go into Nigeria because, there's instability, there's always instability, there is no rule of law. They say all sort of things. Now, is there a data to actually give like how, the percentage level of how much VCs factor that? Well, it's possible. There could always be a research into that. But yes, VCs actually do factor that into how they invest. And honestly, that's part of the reasons why you end up seeing ecosystems that are typically calm enough. So for example, now Rwanda has been calm for a while now. And if you look at the venture capital investment going in there, it's been increasing year on year, and even a lot of startups are actually going there again because what the government is trying to paint there is like, a cool, calm, and welcoming political climate. So yeah, it does factor absolutely.
All right. I don't know if there are any questions for Mikail before he gives his final. We gave it out already before, but I don't know if there are any questions. Mr. Shola, I see you on this call, and I know that it's been a very interesting session. Mikail, this is a masterclass, to be very honest. I think that you should.
Yeah. Mika is he's the boss. He's the boss.
Where?
We know.
Not where you are, sir. We're learning from you.
Maybe one last thing that I think might be interesting for the audience. I mean, you said a lot already, but maybe one last thing is you've talked about it, but maybe if you speak to it more directly, because you spoke around it, like the concept of dry powder, right?
Okay. Yeah.
The fact that, like you said, yeah. So if you just talk about the concept of dry powder, so people kind of get that. Because you've talked about it, but you haven't really hammered it. So it'd be good to just hammer that point. But yeah.
No, absolutely, sir. No, thank you very much for that. So, dry powder. So what dry powder basically means is the money that VCs have or investors have that they're willing to invest, but they haven't invested yet. So that's what dry powder is. And in Canada here, we actually, my firm BDC, we keep a record of that dry powder, and we always post about it every year. So you can imagine was it last year? Last year, I think we had almost 10 point something billion dollars dry powder, basically money that VCs wanted to invest, but they didn't invest for one reason or the other. Now, as of last year, one of the main reasons why Canadian VCs didn't invest that dry powder was because they didn't see a lot of exit activities. So I think throughout last year, we didn't have any startup IPO. I think we didn't have any startup IPO, and we didn't have any startup become a unicorn, if I'm not mistaken, in Canada or something like that. So a lot of VCs were kind of spooked in that aspect. And so some of them so VCs and LPs, some of them didn't invest, or they were kind of waiting to see the right signal. So in terms of Africa as well, I want to believe we have a lot of dry powder. I haven't seen any research along that line, but I want to believe we have that. We have rich individuals, like Ogashola on the call, that we have rich individuals like him that have money to invest in the startup ecosystem, but either they're not confident enough to put their money there, or maybe they're not seeing the right signal in the ecosystem. So for example, if I was based in Nigeria and I had money, for example, to invest in startups, will I really do that? Maybe, maybe not. I'll be thinking, if I was to give, let me use Kautar as an example. If I was to give her money now, when will I get my money back? Will she ever exit? Will that ever happen or not? And again, that's simply because we are not used to seeing exits. We're not used to seeing IPOs, secondary market acquisitions. But because we're not used to seeing that, our muscle memory is not always going to, okay, yeah, this can happen now. If I give her my money, she can either exit through getting acquired by UAC or IPO. And then also, like I said, the government and the rest are not really backing the ecosystem. So again, if my government is not backing the ecosystem, why should I? It's almost like the case of what's happening with the CNG, the gas, what do you call it? The CNG gas tank all that conversion stuff they're talking about, where people have been talking about it for a very long time, but nobody really wanted to do anything about it. But once the government started saying, oh, you know what, we want to convert all Lagos buses into CNG gas, they started, I think, putting money into plants to convert it. All of a sudden, other people started coming out with money saying they want to convert their car or they want to create what's the name, conversion shop or something like that. So there is dry powder in Africa as well. We absolutely need to be able to channel that dry powder into investing. And then part of the ways of doing it will be collaboration also between the government, the VC ecosystem, and also pension funds, the industries. So imagine tomorrow now, if imagine tomorrow if Otedola, what's his name, Aliko Dangote, this man of UBA, forgotten his name. Oh God. This UBA, imagine if 3 or 4 of them come together and say, look, you know what? They want to create a CVC, a corporate venture capital fund, or they want to just create a fund to invest in startups, and they just drop, boom, half a billion or just $1 billion like that. And then they say, okay, anybody creating VC fund will give you XYZ. They basically create something around that. Then all of a sudden, you start seeing people bringing in money from left, right, center, wanting to collaborate with them, wanting to actually tap into the money they're investing. And I bet you, if they were to do that and say, let's say, use the Israel strategy and say, look, you know what, $1 billion, we want VCs from outside Nigeria to come in and partner with other VCs within Nigeria, and we'll give you XYZ. I bet you that $1 billion could actually attract up to $10 billion. And that's just Nigeria alone. So now imagine doing that in different parts of Africa. So there is the opportunity to do that, and hopefully we get there as well.
All right, thank you. There's Sadiq Olamilekan, also from the community.
Sadiq, you and Kautar should partner. Since you are doing, so I know Sadiq from way back. He does all these Uber food delivery apps and all that. Go on, Sadiq.
I'm open to collaboration.
Sharp. All right, Sadiq.
Sadiq, are you there, Sadiq?
Oh,
by the way, maybe Sadiq, I don't know if you're on mute.
He's unmuted. He's not just speaking yet.
Okay. Sadiq, we can't hear you in case you're talking. Oh, Kautar, just to piggyback on what you just said before Sadiq comes back.
Can you hear me?
Yes.
Oh, we can hear you now. We can hear you.
Okay, so yeah, I said yes, we are open to collaboration, right? In fact, collaboration and all this stuff now are not the least of our problem, right? But at least like you mentors, we always say like we should start small. The problem is we don't even have an investor to even want to start small with us. Like I mean, for example, now let's say yes, Jekait has built, we've done our 3,000 orders, we've even expanded back to Lagos, and we want to push things. We basically don't need 100 million naira, 50 million naira to scale things. Like we just need this an investor like take this 10 million naira. Yes, I know this money might be a chicken change for me, but I am interested in getting back this also profits, and I want to know what we are going to use this money for. We want to do marketing. How much is influencer marketing in Lagos? The least I can pay with the likes of the Oli Malik and Co. at 350K and so, and we are going to reach some audiences, right? But we don't even have these small investors that want to put their money down with the excuses that Nigeria is volatile or something like this, right? So what can we do? Like, I mean, we need some investors who can trust. And we know Africa is volatile. We know we are thieves. We know we are this. But not all of us are in this situation. Some of us are like, we've fought our ways up. We've built this product, all our savings, all our funds. We just need somebody that can trust us. So just take us from 0 to 1 that we've gotten ourselves, then from 1 to the next stage. Yeah, that was what we need. How can we get to this stage? Right? So that is it. Like everything you explained, I get everything clear. I've been reading your like all the information you sent to me, to us, and yeah. But now we've done all those things you asked us to do. we want to move to the next stage, and it's very frustrating now, like moving to that next stage. So what can we do? Like, how can we get into these funders to just support us in a small way or something? Yeah.
Okay, so no, thanks for that question. So again, you know what? Honestly speaking, you will have to keep doing what you are doing. And what I mean by that is, as a startup founder, your first target for funding should always be your revenue. So just keep building your revenue, keep taking care of your customers, and as soon as keep taking care of your customers, and as soon as you need their support, trust me, they will definitely come through. And what I mean by that is basically this. For venture capital, like for VCs really, or even investor, any kind of investor, what we want to see is that customers want your product, you're offering value to your customer, and you're growing, right? So those are some things that you need to show. Now, the other thing also that you need to be able to understand also is that there are different kind of investors and there are different kind of startups building different kind of businesses. You might not need VC money right now, or VC money might not be right for you right now. So if it's 10 million that you need, you can always look inward, look for high net worth individuals, people that you know, friends and family. And again, I can touch on friends and family later on because that's another challenge that we have on the continent where friends and family check is not necessarily forthcoming, but you need that to be able to build the base for what you are building. Also, what I would just say is keep digging at it, keep looking for high net worth individuals, look for opportunities to collaborate. So, for example, the influencer marketing that you said you wanted to do, one way of doing that without necessarily raising venture capital money could be reaching out to those influencers that you want to use. You can tell them that, look, you want to do a revenue sharing agreement with them where they will post about you for marketing and all that, but then instead of you paying them cash immediately, you can structure a kind of financing model where you pay them, either whatever amount that comes out of that, marketing. Now, guaranteed, I'm very sure that a lot of the influencers, their mouth is already wide open. They've already seen plenty money. They might not want to take up that offer. But again, that comes into what we call it.
Other guys that will take it. Nano influencers that will take it.
Exactly. So there will be smaller influencers that will take, and truly, and let me tell you, honestly speaking, you don't necessarily have to go and meet, the big guns. I don't know, is it which example can I even give? So you don't need to go and Davido or Don Jazzy. No. You can start gradually, build on it, and once you start seeing the traction, you can start moving to a higher influencers. And in fact, you could even help those nano influencers build their own brands as well. Yeah. So it could be like a collaborative kind of a thing. So yeah, that's something to think about. But honestly, there is no one size fits all when it comes to fundraising. Fundraising is extremely hard, to be honest with all of you. So as a VC, for example, we might see 100 companies and we only invest in just one. That there's even a statistic. I think there's a data point or statistics that shows how many startups VCs see and then how many they invest in. I know a VC that said they saw almost 400 startups and only invested in 3 or 4 of them. It's because the capital is also limited. And this VC is actually here in Canada. It's because also capital is also limited. It's not just back home and on the continent. Yeah.
I see Ogashola's hands up back. So Ogashola, you can.
And then so Ogashola can add to that also. You should even be pitching to Ogashola.
No, so I think Mikail, you covered a lot of the stuff, particularly around. I'll tell you what one of my startup friends did in Zimbabwe. He basically created a training school for influencers. So these are people that are not influencers, but they have an idea that they want to become influencers. And then he had a chicken spot. He had a couple in Zimbabwe, and he basically trained them to be proper influencers, gave them the training. And guess what? Like, I think he trained about 50 of them. 5 of them are now macro influencers, right? And so whenever he calls on them, they'll be like, okay, you're the one that helped us start. So I think you need to start looking at that. We have to be a bit more creative on how we do that. Second thing, as an angel investor myself, I've written over 41 checks. The reality is sooner or later, body go tire, right? Because you're like, I've written checks, I'm not seeing any return. And even though you know it's a long-term thing, soon your body gets tired. So what angel investors, the people you're looking for, that you want to give them 10 million, what they're looking for when you come to them and say you're looking for 10 million, they want to see the road to revenue. And Mikail knows I like this topic a lot because at the end of the day, an angel investor is not a bank. If you want to get a loan of 10 million naira, go to First Bank, go to any of those banks, and then they will give you the terms of the loan. An angel investor is somebody who wants to give you support and capital on top of. But for that to happen, there needs to be an exchange of trust. And I think Mikhail has already talked about it. So it's not that there's no money. The problem is that the trust, like if I give you 10 million now, what will you do with it? I've given startups, like there's some people that I've given them like $2,500. I know that I'm not going to see shishi in that money ever, but I want to encourage them to kind of go out, try something. $2,500 is about 5 million naira. Go and try it, see if you can make, and then they come back. It didn't work out, but I take that loss, right? But there's only so much losses you can take. You see, the difference between a VC and an angel is VC is investing somebody else's money, and angel is investing their own money that I worked hard for. Basically open tap and just pour out $2,500. So I think there are angels out there. I think on a monthly basis, I have friends that will come to me and say, I'm looking to invest $5,000 somewhere. Where is a good place, right? And it's very hard for me to select a startup to do because they need trust, right? So hopefully that helps answer the question. So there is people out there, I think he talked about it, high net worth people, friends and family, but all of those things need to have a root to how will you make money? Because that's the only way I'll double down. I'm not going to double down on a startup that doesn't show me a route to money. Why would I do that? You understand? So hopefully that's helpful, right?
Yeah. Thank you very much.
Last week I was speaking about career. Today I'm speaking angel. But I like to hide that angel.
Oh, thank you for the wisdom, Gashola, as always. So yeah, absolutely.
Let's have
Go
just
ahead.
the last two so that we can call it a day. It's 2 hours on this call or 3 hours on this call. So let's have Kota and Efe, if I'm right. I would have wanted Adaku, but I see her still hiding her hands. It's fine.
Okay. So I just want to speak to what Oga Mikail said. It's not sometimes at this point, it may not be at the level of equity, it may not be at the level of angel investor, it may just be at the level of grants, and that's what I've used to build my company. I told myself, if I walk up to any equity investor right now, and I'm telling the person, come on, like, what's my traction? What's this and so what? I join as many acceleration programs as possible. Have been able to get grants. So sometimes I can get a grant that this money would just be meant for NAFDAC. I'll get another grant meant for machinery. I'll use another grant meant for maybe marketing. I really don't look down on any amount, even if it's $300 to give me out. Thank you for it, because I know that I'm still going to do something in that business. So, because I've gotten $300, I've gotten $10,000. I got paid $50 this year. So I don't look down on any money. Money is good. Any money that you give me, it will do something.
You're making money. Show us love. Show us love now.
And that one has really helped me to build. There's this thing about the network you were talking about, sir. That network has also helped me a lot, and so that's why when I jumped on saying I'm open to collaboration. So he said he's in Mina. I'm in Lagos. I buy raw materials from Mina. So I have customers in Abuja, in Kwara, and all that stuff. So that means there's so many things we could do together. And lastly is the fact that there's something that all of us we don't understand is that, yes, you may be doing everything, but not everybody is going to be on your team. So for the influencers, what I do is I have some chefs. I'll tell them, okay, you guys are having an event. I'll give you some of my products for free. So when they're having those products, when they're sharing it to their friends, people will see it. They will tag me. And I'll definitely, my PR is very good. Though. I'll just go and do a video, a small skit about it, and I share it and post it on every platform. That yes, I supported Chef Eiz. Chef Eiz was the one that used counterfeit products and all that stuff. So what I think he can also do is co-creating some products. Mr. Ayola, if you remember the last time I made a question in one of the series that we had, the man that talked about grants. Yeah. And I reached out to him personally, and he told me that, okay, yes, we could do this grant at a nominal fee and all that. I told him, sir, right now, I do have that nominal fee. I'll go and work hard and come back. And I'm working hard. And I know that, okay, yeah, by the time I'm able to raise that nominal fee, and I'm able to use that to get other grants, the bigger dream I have, I can do it. So if you're looking at getting influencers, getting those big guys, you think, start with the nano influencers like you mentioned. Those nano influencers will be the one to help you, that you get customers that will believe in you. So you should co-create some business. So just tell the nano influencers, okay, if you have deliveries, free deliveries, I can offer 5 free deliveries for people in your platform. And they will mention you, it will tag you. And so that way people get to know about you. So I think that's just about it. Thank you.
And then, in fact, thank you very much, Counselor, for that. And just to quickly add on that, it's always, what Counselor said and Ogashola, try to be as creative as possible. In fact, you might not even need those influencers if you take other kinds of strategies. So for example, I know you do food delivery and all that. Why not just collaborate with even the customers that are delivering for and say, hey, when we deliver for you, can we make like a short, funny video or interesting video of, this is, what's the name? Jekka 8 just brought this or something like that, make it nice and just create, you can use some AI product to make it look nice. And then you can start to actually be your own influencer or your own marketer on Instagram, TikTok, wherever it is that your customers are. And then you start posting. Yes, you can partner with, influencers as well. But again, it's always good to try and be creative. Try to see how you can use as little money as possible. So I think those are great advices.
All right, Ife, the final one for today, Ife, please. I want to be able to call on Mikail tomorrow and say, come and scatter a conversation, and he will say, okay, I'm coming. Not that you people will take my whole day. Okay.
Is this Big Brother Ife?
If
I don't, are you on mute, Ife?
Oh, he needs to unmute himself. Probably still figuring it out. Okay, so what I'll just lay out to the conversation around influencer. Okay, Ife, over to you.
Yeah. Hi. Good afternoon, everyone. Thank you, or good evening, rather. Mr. Mikali, I don't know if I pronounced that right. Thank you so much for the insights on all of that which you've said. So it's quite insightful. But in recent times, I have discovered that there have been some issues around, raising funds. Do you understand? There have been some issues around raising funds. So I had a conversation with a friend of mine, we co-owned a startup like that in the UK, but we try to pitch to a particular VC now, and then they back up someone or an organization that is very close to what we are doing, and then they showed interest in what we are doing. And then while they showed interest, it seemed so good, we're already in the conversation and all of that. And all of a sudden, we had one of our person inside the other organization that was willing to join us to work with us, and then the next thing is coming to tell us, oh, this person from this VC is talking to us about having these add-ons, And I was like, God damn it. Like, we just created something, and then you are wondering that you were pitching to people, because they always tell you that pitch to people who are that invest within XYZ kind of businesses, So that is something that's it's pretty much discouraging, for someone that is a startup founder. And then also, I think I've been, apart from that, I also own a ride alien startup, which is staff ride, basically focused on workforce with a bit of HR kind of construct around it to just aid some form of securities and all of that to make sure that we have the right set of people, signed up. But these have been my concern. And in recent time, I'm having a VC that is also talking to me that also backed up someone that is, like it's also a competitor that's Shotlas, to us. So I'm like, these toxic people are talking to me. I'm you get to that because we've had that issue before. So now there's also this fear factor, like, okay, should I open up completely?
Okay, so you know what, that's a very good question, and it is unfortunate that I'm hearing that, because I think I've had that once too many now. So here's the thing. There are some VCs that are specialists in a particular field where, let's say, they only do fintech, There are some other VCs that they are generalists. They will do everything, and they can do repeat investment as well. I know there are some VCs that will not back a competitor in the same geographic space within their portfolio company. So, for example, I know the VC that invested in Trips here in Canada. Now, that VC will never back any other mobility company because that's just their own distance. They will not back another mobility company to come and compete with Trips here in Canada. So I'm just trying to differentiate some other things. However, what you just said right now, it is something that happens, unfortunately, with some VCs that are not so straightforward. And of course, as there is the mistrust or lack of trust on some founders' side, there are some VCs that also lack integrity and all of that. What some will do is exactly what you just said. They will talk to you because they have a potential, well, they've already backed the company already, right? So they will talk to you, look at what you are building, gather data and information from you, and even maybe copy your your product, and then go and tell their portfolio company that, hey, this is what you should add, this is what you should add to make your company even bigger. Because again, in their own mind, if that company does well, that is their own money growing. So why not just steal your own idea and pass it to that guy? So although it's sad, but unfortunately it happens. So what you can do as a founder is, number one, before you even start talking to once you try and get in front of a VC, before start pitching to them, try to do some due diligence on them as well. So the way we VCs do due diligence on you founders, you should also do on us as well. So part of what you can do also is to look at, Google them, find out what you can find out about that particular VC. If you can reach out to some of their portfolio companies, try to reach out to those portfolio companies just to get a feel of, all this kind of. If you reach out to one of the founders in their portfolio companies and that founder is telling you, oh, that VC is amazing. Like when we joined them, we only had 2 features on our product, but by the time we joined them for 6 months, we've increased from 2 features to now 5 features, or they've helped us add more products and all that. Then that should start bringing up warning signs and alarm signs on, for it that you started with only 2 products and now your VC has helped you to add 3 more products or something like that. Then you start to think, oh, something is wary. Now, you don't need to stop talking to that VC, but it just lets you understand how to talk to that VC, what to disclose and what not to disclose. And in fact, you can just back off. If the red signs are just too much, you can just leave that VC alone and then move to something else.
Right.
Now,
the big question, Mikail, is
yeah.
I've had founders say, should I give a VC an NDA?
So I was going to come to that actually. I was going to come to that. So now, if you don't want to back off from that VC, or maybe you think, oh, maybe it's just false red flag, there are other ways to do it. Most VCs will not sign an NDA. That's just the truth. Most VCs will not sign an NDA. The only time VCs begin to sign an NDA is if there is an IP involved and they want to take a look at that IP, or maybe they want to take a look at your code, your tech, and all that. But if it's just for you to just pitch, just present your startup on a PowerPoint, mostly, in fact, I don't think I've ever signed an NDA, and I don't think we've ever, since all the deals I've been doing, I don't think we've ever requested for any NDA. Maybe because that's what, because hey, we are government backed and people will expect that we do the right thing. But we don't sign, and most VCs I know don't sign NDA. But like I said, if there's an IP involved, absolutely, you can pitch to the VCs, tell them what you are doing. When it comes to, oh, okay, want to do a DD, want to take a look at your data, your data room, or we want to take a look at the back end of your product, see how everything works, then they can then sign what's the name, an NDA. But at the initial stage, what you can just try and do, just keep it brief, keep it to the overarching idea, because at the end of the day, what you need to understand is that even when someone tries to steal your idea or the way you want to build a product, they will not be able to execute the way you can execute. And the other thing also is that a founder that keeps adding features or products on top of what they are building, then they start to become, they are no longer in a niche area anymore. They might not be as good as what they as what they were already doing before. So that's one thing to so that's one that's one thing to just think about when you are going into these conversations with VC. Do your due diligence, keep everything high level for the start. If there's an IP involved, then absolutely you can definitely get an NDA for that.
All right. Thank you very much, Mikail.
Thank you very much.
You're welcome, sir.
I'm going to have to close the session now. It's been great having you here. You've opened my perspective towards, governments differently. I used to think that, when it comes to governments, it's a lot of institutional investors conversation, better governments having all that institutional conversation when it comes to investing. But right now, I see a different perspective. Governments can also have their own set aside venture, if that's the right
Yep.
word.
Yep.
Do we have this year? Maybe not yet. Maybe I
We
need
don't.
to do some research. But I think
No,
that
we don't.
what we've not spoken about, Mika, is data. I think data also suffers us a lot in Africa. A lot of the things you've been saying, you backed it up with data. Oh, in Canada, there's data there, there's data here. Maybe the data part as well also puts a lot of setback to investors who are looking to even invest, whether local or international. There's no data to say, oh, that's the size of the market. Who is giving me the size of the market? Who is saying that, in 2 years or 3 years, this startup has the potential to get there because there are data that shows XYZ. So I think that that's also another problem. I don't think that the problem we will solve today, but I think that I will have you back here one of these days, to discuss your own thesis to investment.
All right. Yeah. It's funny you said that because there is a this is still under wraps for now, but there's a VC firm that is trying to get me to create. So I create wasn't in VC fund strategies as well, and there's a VC fund that is trying to get me to create one for the African market. So it's actually quite interesting that you mentioned that. So yeah, absolutely. Yeah, we can talk about that and the things that we look out.
Spirit. I like that I'm in the spirit. Beyond borders and boundaries. I can see what's
absolutely right.
Absolutely.
All
right. Thank you everyone for joining. It's a wrap for the month of August. September promises to be very interesting. I have David Odekoya, I think that's his right name. David also coming on the call to speak venture. A couple of other interesting people. I think Ada as well has confirmed that she's coming in August to just come tell us, a few things around the founder's perspective. I've had a couple of other very interesting people. So Benjamin Udoku is coming to speak to us on from hype to substance, building trust between founders and funders. He's also, he used to be at AA Collective. He's done a couple of scouts within and outside the country. Adaku, very interesting person. She's going to come in to speak to us around scaling in Africa, growing a business in a fragmented market. I think that's a very interesting conversation to have. David Ogundeko, that's the name I was trying to remember, is also coming to speak to us on the 27th. Adaku is on the 20th, and David Benjamin is on the 13th. There's a young man who I'm also very interested in. His name is Kudus Oluwatosin, also coming to speak to us on something very interesting, first week of September. So that's the lineup for September. We've done a couple of episodes. You can also find them on YouTube. But Mika, I think that you need to send us this your deck so that we can get more people. Maybe you can even start the conversation with the government around this. And Mr. Shola, I think that you give me
Mr. Shola is in the best. No, Mr.
Shola, that assignment. Because you understand it way more better, and maybe if you can just get to the doorstep of the government to see this. I think that the problem is the guys who are there are basically just thinking about it from their own perspective of investment rather than trying to help the government see that there's a route to helping the startup and helping them.
Yeah, I know you're trying to close the meeting, but I would say that if there's any government, just like Obasanjo's government was good for mobile, I think this is the best government for internet investment, because I think Tijani has a mindset to do the right thing, and he's got right people around him. So maybe this is the time, right? Maybe it's the time. So let's see. Let's see. We can only hope.
So Mika, you're coming home soon. Homecoming.
No wahala. Looking forward to it.
All right.
Looking forward to it.
Have a great day, everyone. And thanks for joining.
Everyone.
Mika, it's an honor that you honored us. Thank you very much.
Thanks for having me. Thanks for having me, man. All right. Take care, everyone.
Bye.